In the 1950s, Wall Street operated on a simple rule: proximity. If you wanted to succeed, you had to be standing right here, on the crowded, chaotic floor of the exchange. Traders relied on a physical lifeline to make their decisions. The ticker tape provided the only source of market data, and without it, you were trading in the dark. Nicolas Darvas managed to pull over $2 million out of this market without ever visiting a brokerage or watching a live ticker. His primary occupation was ballroom dancing. While the professionals were glued to their terminals, he was performing on stage, often thousands of miles away from New York. This raises a question: how did a complete outsider, working without real-time data, manage to beat the most connected insiders on Wall Street? Darvas was born in Hungary and studied economics before he fled the country during the Second World War. He arrived in Western Europe as a refugee with almost nothing. He rebuilt his life through physical discipline. He trained for hours every day, eventually becoming part of one of the highest-paid ballroom acts in Europe. In 1952, a Toronto nightclub owner paid him for a performance in stock instead of cash. Darvas received 6,000 shares of a speculative Canadian mining company. He held the stock out of curiosity. When he checked the price months later, it had tripled in value, handing him a profit larger than anything he had earned through dancing. The experience had a significant psychological impact. He had made a fortune by accident, holding a stock he barely understood. This windfall created a sense of false confidence. It led him to believe the stock market was a predictable machine where money was easy to come by. Darvas began chasing market tips and financial newsletters. He tried to mimic the experts, constantly looking for the next big move. His trading became reactive. He bought stocks based on hype and sold them the moment the price dipped, driven by a fear of losing his initial gains. His lucky streak quickly ended. In a series of losing trades, the capital he had gained from that first mining stock vanished. There was a clear pattern. The more expert information he consumed, the faster he lost money. Darvas eventually realized he was merely gambling with a better vocabulary than the man at the roulette table. Mimicking the reactive, hyper-connected behavior of Wall Street insiders proved to be a reliable way for a retail trader to lose everything. In a hotel room during his tour, Darvas finally admitted he lacked a methodical system. He was trading on desire rather than a plan. He decided to cut his connection to all real-time Wall Street data and broker opinions, choosing to trade without the constant feed of market news. He managed his portfolio from his tour stops in Asia, moving from hotel to hotel in cities like Hong Kong. By the time he reached Saigon, he was thousands of miles away from the nearest exchange, completely disconnected from the New York financial hub. He communicated with his brokers exclusively via telegram. He based his decisions on stock prices found in newspapers that were often several days old by the time he received them. This delay acted as a filter. It forced him to ignore intraday price swings and focus on long-term trends, allowing him to build a mechanical system that removed emotion from the trade. For an outsider, the primary advantage comes from filtering out the noise until only the market signal remains. Step onto the floor of a mid-century stock exchange, and you are immediately assaulted by noise. Traders are shouting over each other, reacting in real time to every fluctuation on the ticker tape. For the average investor, this environment is a trap. When you are surrounded by instant tips, whispered rumors, and frantic crowd movements, your brain naturally wants to follow the herd. Even reading the daily financial paper creates a dangerous illusion. It feels like doing diligent research, but it often encourages traders to guess where a stock is headed based on yesterday's headlines rather than hard data. When you consume a chaotic, real-time feed of information, you stop executing a strategy. You start making financial decisions based entirely on emotion and impulse. Nicolas Darvas operated completely outside of this Wall Street bubble. He wasn't a financier or insider. He was a professional ballroom dancer. His career required a grueling international tour schedule, meaning he spent his days moving between foreign hotel lobbies, entirely cut off from the immediate ticker tape and the shouting men in New York. At first, Darvas tried to play the insider game anyway. He asked people for tips and tried to trade on rumors, but because of his geographic isolation, the information was always stale by the time it reached him. He lost money repeatedly. Instead of fighting his physical limitations, Darvas leaned into them. He realized that to survive, he had to build a method that required absolutely zero human intuition and no real-time screen watching. He stripped away all fundamental analysis. He stopped caring about earnings reports or corporate news. He decided to track only two objective metrics that he could receive on a delay: price and trading volume. This chart shows the specific pattern Darvas looked for. Before a stock makes a major move, it tends to consolidate. The price bounces between a distinct ceiling and a strict floor, forming what Darvas called a box. He established a strict entry trigger. He would only buy a stock when its price broke aggressively through the ceiling of that box, accompanied by a massive spike in trading volume. But the most critical part of his system was the failsafe. The moment he bought, he placed a stop-loss order slightly below the floor of the box. If the breakout failed and the price dropped, the system automatically sold his shares, resulting in a tiny calculated loss. There was no room left for opinions. By adhering to these rigid criteria, he transformed investing into a strictly mechanical filter. This mechanical logic was exactly what his touring lifestyle demanded. Because the rules were absolute, he could issue instructions asynchronously from anywhere in the world. He sent telegrams to his New York broker containing strict conditional orders. He didn't ask for advice, and he didn't require final approval before a trade was executed. This diagram shows how he locked in his gains remotely. As a stock successfully climbed and established a new, higher box, Darvas wired his broker to move the stop-loss up to the new floor. He trailed the price upward, step by step. By utilizing the Telegram network to execute preset logic, Darvas effectively coded his own hesitation out of the process. The machine protected his capital while he was on stage performing or fast asleep in a different time zone. Running this system required ruthless discipline. Darvas explicitly refused to buy stocks simply because they looked cheap. He only allocated capital to assets that were actively proving their strength by hitting new highs. If a stock triggered his stop-loss, he cut the position instantly. He never bought more shares to average down his cost on a losing trade, and he never held on to a falling stock out of hope that it would bounce back. There was zero negotiation. If the mathematical criteria broke down, Darvas was out of the trade. By 1957, executing this emotionless system with absolute conviction allowed Darvas to compound his investments into massive gains, eventually turning thousands into millions and capturing the attention of the national financial press. Compare that to the modern retail investor. Today, we are bombarded by a 24-hour news cycle and screens that update our portfolios by the millisecond. We have unlimited data, yet it routinely causes analysis paralysis and panicked selling. Darvas proves that an information advantage isn't about having the fastest feed or the most data. True advantage comes from possessing a strict set of rules that completely removes your own emotional reactions from the equation. Take a look at a modern trading desk. It is a sensory overload of real-time data feeds, algorithmic alerts, and charts updating by the millisecond. We operate under the baseline assumption that surviving the market requires this level of connection. We assume that if you aren't consuming every piece of news and reacting to price action in split seconds, you will be eaten alive. This anxiety isn't entirely new. Even in the 1950s, the physical floor of the New York Stock Exchange was a chaotic, paper-driven scramble where professionals fought for immediate information, which makes Nicolas Darvas a complete anomaly. He had zero Wall Street training. His day job was working as a professional, world-touring ballroom dancer. Yet, starting with a stake between $25,000 and $36,000, he pulled millions of dollars in profit out of the stock market, operating entirely without insider access or real-time tickers. His success exposes an uncomfortable reality for today's hyper-connected investor. Extreme access to information is often a trap, not a prerequisite for building wealth. Over a roughly 18-month period, Darvas was physically cut off from the New York financial hub by the grueling constraints of a global performance tour. He was performing across Calcutta, Paris, and Tokyo. He had to navigate massive time zone differences and communication barriers every single day. His only connection to the market came through reading days-old newspaper quotes and receiving sparse, highly delayed international telegrams from his broker. Back in New York, the professionals sitting in the shadow of Trinity Church were reacting to every intraday dip. Darvas, meanwhile, would often let days pass between his check-ins on a position. These severe physical constraints forced his hand. Unable to hear the market's daily noise, he had to rely entirely on a slow, deliberate, long-term plan. In his early years, Darvas traded exactly like most beginners still do, chasing hot tips and buying on blind hope. To survive his tour, he stripped out human emotion entirely and replaced it with a rigid, mechanical process. This is the box system. He tracked prices moving sideways within defined boundaries. A buy order triggered only when the price broke the ceiling. He then placed an automatic stop loss just underneath. If the trend reversed, the position was cut. Because these mathematical thresholds were absolute, Darvas could execute his entire strategy via those delayed telegrams. His broker simply followed the predetermined numbers, requiring zero hesitation or direct supervision from Darvas. With a stop-loss order sitting quietly behind every trade, his portfolio was protected. Even if he was entirely occupied with a world tour and couldn't check the market for a week, his financial ruin was mathematically impossible. The box system served as an absolute emotional shield. By stripping away his ability to react in real time, his inability to watch the market became his sharpest competitive edge. The final tally of this telegram-based, low-information strategy was staggering. Darvas turned his initial stake into a profit of over $2 million. When his results were audited and made public, the financial press and professional money managers treated the story with absolute disbelief. He published his method in a 1960 book that remains a staple of trading literature over 6 decades later. But traders don't study it for a secret technical indicator. They study it for the plainness of its discipline. The lesson for modern traders operating in an era of algorithmic noise is counterintuitive. To survive the deluge of data, you have to voluntarily impose that same distance on yourself. An amateur trading on shifting feelings and intraday wiggles will always struggle against the math. A fixed mechanical rule for entry and risk guarantees stability. We have more data flowing across our screens in a single minute than Nicolas Darvas had to process in his entire career. True market victory doesn't come from obsessively watching that data closer than everybody else. You beat the market by engineering a system disciplined enough to work perfectly, even when you aren't watching it at all.